Yes, hello guys. Good evening. We are moving on with our revision. So today we are continuing with the revision financial management. April 2023 question 1B. April 2023 question 1B. Here how the question goes. SIPO Limited is evaluating an investment project which requires the importation of a new machine at a cost of 3,700,000. The machine has a useful life of 6 years and a salvage value of 1 million. Additional information. 1. The following additional costs would be incurred in relation to the machine. Modification cost 1 million, import duty 900, installation cost 375, freight charges 225,000. Additional information. 2. The machine is expected to increase the company's annual cash flows before tax as shown below. Before tax, very important point. You can see the cash flows there. 3. The machine is to be fully depreciated over its useful life using the straight line method. 4. The corporate tax rate of 30% while the cost of capital is 10%. 5. The maximum acceptable payback period for the company for all capital projects is 4 years. Required. A. Total initial cost. B. Annual or Roman 2. Annual net cash flows. Roman 3. Payback period of the machine. Roman 4. Net present value of the machine. Roman 5. Advise the company's management on whether to import the machine based on your results in B Roman 1, Roman 3, and Roman 4 above. How many marks? 2 plus 3, 5, plus 3, 8, plus 3, 11, plus 1, 12. 12 marks. We are handling it now. Welcome live. Yes, A is saying the initial investment. So A is saying calculate initial cost. Initial cost, when you go to our notes, when you go to the notes that I shared, you find that I've used the word initial outlay cost. So it is the same, initial cost. So this is the cost that is needed for the replacement of this particular machine. Now, for this one now, we need to start by saying, yes, let's first of all calculate the initial cost that is needed. Here, we just handle the incremental cost. How much is the increase in terms of cost? So in this case now, we need to say what is the purchase of the machine. The purchase cost is how much? 3,700,000. 3,700,000 is the cost of that machine. You add any installation cost if there is any installation cost or any additional cost. So in this question, we normally say add installation cost. But in this question, we have several items of costs that were added. One is the modification cost of 1 million, import duty of 900, installation cost of 375, and freight cost of 225. All will form part of the additional cost so that we now get the correct cost of this machine. So therefore, we say add Roman 1 modification cost, 1 million, import duty, 900,000. We have installation costs, installation cost 375,000. We have freight charges These are costs that actually come up when you have purchased that particular asset. So therefore you need to add all for you to get effective cost. So when you add this, the answer you get is effective cost. Effective cost. So how much is that figure? How much is that figure? So you add 3,700,000 plus 1 million plus 900,000 plus 375,000 plus 225,000. So your figure is 6,200,000. 6,200,000. From here, we now calculate what you call tax advantage or tax recapture, if there is any. So in this case, we don't have any incremental for that case, but we shall have now the incremental depreciation. Here we don't have, the old machine is not there, so we have the new machine, we can depreciate that. So in this case now we don't have any for the new, so we calculate now our, this is our incremental depreciation. So here we now say, either we now take tax advantage. Tax advantage, we normally take the net book value of the old machine. Okay, the net book value of the old machine we don't have here. Then we now say less, okay, market value of the old machine. Market value of old. We subtract. In this case, we don't have that. So therefore, this one here, dash down, we bring down here and say 6,200,000. So 6,200,000 is now our initial cost. How many marks? Marks there, 2 marks, sorry. Roman 2. Roman 2 says annual net cash flows. 3 marks. Annual net cash flows. So when you talk about cash flows here, we are not going to include our depreciation. Depreciation is not the actual cash outflow. So therefore, we will subtract depreciation, yes, but we'll come and add back so that we arrive at the net cash flow. The word net here means take the revenue, okay, or take the cash flows given, then you subtract any expenses. In this case now, you can see there, we have how many periods? We have here periods here, year 1, 2, 3, 4, 5, 6. So those are the periods. So we have the cash flows before what? Cash flows before, they have said cash flow before tax. So here we have 1760. Here we have 1360. Here we have 1050. Here we have 900. Here we have 840. And finally we have 750. So before you apply the tax of 30%, there is a depreciation that this particular machine is undergoing. So you now say less depreciation. Depreciation, you take now the cost is now this one, 6,200,000. You minus the salvage value, which is 1 million as given up there. 1 million. You divide by how many years for this machine? This machine was to last for 6 years. So you get the depreciation per year. So in this case now, we can work using thousands because of this case. So we take now 6,200 minus 1 million. Then you divide that by 6 years. So per year, you will get 867. 867 per year, 867 per year, 867, 867, 867. So immediately you subtract that, you get now earnings or cash flows, earnings before what? Tax. So yes, so let's see. So let's subtract 1760 minus 867. I'm getting here 893. The other one is 1360. No, there's a mistake I've done. There's a small mistake I've done. Here, let me explain why. Here. Sorry, there is a mistake I've done here. Now, this cash flows means that it has already captured our depreciation. Because depreciation has already been captured, we just need to provide for the cash for the corporate tax. So provide for corporate tax only. Corporate tax. Because this cash flow means that you have already deducted all the expenses before. So what is remaining is only the tax. So confirm that now. Tax 1760 times 30%. 1760 times 30%. I'm getting 528. 1360 times 30%. My answer is 408. Another one is 1050 times 30%. Your answer is 305. Another one is 900 times 30. Your answer is 270. Then 840 times 30. Your answer is 252. Then the last one is 750 times 30. Your answer is 225. So subtract now and see how much is the cash flow. So it will be 1760 minus 528. Your answer is 1232. The other one is 1360 minus 408. Your answer is 952. The other one is 1050 minus 315. Your answer there is 735. 900 minus 270. Your answer there is 630. Then the other one is 840 minus 252. Your answer there is 588. Finally, 750 minus 225. Your answer there is 525. So these are now the accurate cash flows. So the question was saying annual net cash flows. So this is the figure. This is the figure. So annual net cash flows. So now the correct, then the final total now net cash flow. Total cash flows. Cash flows. It's just addition of all this. So you take now 1232 plus 952 plus 735 plus 630 plus 588 plus 525. So the figure there is 4,662. So that is exactly what that examiner wanted you to do. The annual net cash flow. Yes. So this is the figure. Next question. Payback period of the machine. Payback period. Roman 3. Payback period. payback period, we normally say it is the time taken for the investor to recover his or her investment. So in this case, the investor has invested this much. How many years will this particular investor wait for him or her to recover his what? Investment. So in this case, this one here uses purely the cash flows here. So therefore, we now put like this, period here. Period 1, 2, 3, 4, 5, 6. So payback period, we normally say it uses the cash flows. So 1, 2, 3, 4, 5, 6. Then you say cash flows. Here it will be, the first one is 1232, 952, 735, 630, 588, finally 525. So here we want now this particular person to recover his investment. How much is his initial investment? So in this case, we have discovered that his initial investment is this one here. So kuna kitu nimekosea kidogo. Hello guys, welcome again to our financial management revision class online. So we are continuing with the revision. We are doing December 2023 question 3C on loan amortization. Loan amortization. Loan amortization. Amortization. Yes, that is the topic, loan amortization under value of money. Now, loan amortization is a very important topic, and it always comes there in your exams, and it carries around 4 to 5, 6 marks around there. So let's now handle this question. It reads, an investor plans to borrow a loan of 3 million to purchase a piece of land for his family. The interest rate agreed upon is discounted at the rate of 10% per annum. The loan is repayable in 4 years of equal installments. Required A, amount payable per installment, 1 mark. Roman B, a loan amortization schedule, 4 marks. So let's begin. First and foremost, what is very important here, you need to understand some specific terms. The term that is being used in the question is installment. Installment is made up of the interest and the principal. So therefore, when you calculate that particular installment, you need to be very smart. So we say now, installment is given by loan divided by present value interest factor of annuity at the rate of 10% for how many years or periods? 4. This loan interest here is annuity. Annuity means it is a constant amount of money either received or paid at the end of every period or at the beginning of every period. We normally say we have the ordinary annuity and the annuity due. So there are 2 types of annuity. So in this case, loan divided by present value interest factor annuity at the rate of 10% for 4 years. Therefore, it will mean then I take my loan of 3 million here, you divide by present value. In this case, it is 1 minus into brackets 1 plus R. In this case, R is 1, 0.1 power negative 4. You divide this one by R, 0.1. This will give you what percentage? So in this case now you take this 1 minus 1.1 power negative 4. You get the answer, and then you divide that by 0.1. Your answer is 3 point. So this one is 3 million. You divide by 3.1699. What is your installment there? So you take 3 million divided by 3.1699. Your answer there is 946,402. 1 mark. Number 2, Roman 2 is loan amortization schedule. Roman 2 is loan amortization schedule. Yes, these are table. What is very important here is the format itself. It is very, very, very important. First part of the format will take the period. Immediately after the period, we will have now the balance brought down of the loan. Then immediately after balance brought down, we have the interest. In this case, at the rate of 10%, if I'm not wrong. At the rate of 10%. Then you add the loan plus interest to get the total. From the total, you'll have the principal. Then from principal, you will have your installment. Then finally, balance carried forward. Balance carried forward. Very important format. Yes, that is the format. Now, we begin. There are how many? They are paid in 4 installments. So 1, 2, 3, and 4. So at the beginning, in the first year, we are given a loan of 3 million. 10% of this is 300,000. Total here is the amount of loan plus the interest. You are supposed to pay 3,300,000. Okay? Now, installment already we have calculated here. So it is a constant amount. So it will be constant up to the 4th year. So here will be 946,402. This one will be 946,402. The third one is 946,402. And the last one is 946,402. Now, principal, remember we are saying installment is equals to interest plus principal. Because we have already the interest here, we can easily get the principal by saying installment minus interest, which is 646,402. This minus that. Now, for us to get the balance carried forward, you take the total amount, you minus the installment. So you minus installment. So 3,300,000. You minus 946,402. 3,300,000. You minus 946,402. So your answer here is 2,353,598. So the balance carried forward becomes the balance brought down in the coming period. So here will be 2,353,598. So 10% of this is 235,360. You add this plus this, what do you get? 235,360. Your answer here is 2,588,958. For me to get here, it will be this minus this. So I will take my 946,404, you minus 235,360. So your answer here is 946,402 minus 235,360. So I'm getting here 711,042. So for me to get the balance there, I should just take a total. There is 2,588,956. You minus 946,402. So your answer here is 1,642,556. Then you bring here 1,642,556. 10% of this is 164,256. So you add 164,256. So your answer is 1,806,801 and 12. Like that. Now for you to get the balance there, you take this minus this. So 1,664,256. So 1,642,556 minus 946,402. So your answer here is 696,154. It is the beginning here. 696,154. This one is 10% of 69,615. So you add 69,615. Your answer here is 765,769. So if you minus this and this, it has to give you what? The last one is always 0. So when you add now this plus this minus this, you automatically get what? 0 here. So here is 0. So this is how you are supposed to handle that question. That is how you are supposed to handle that particular division. So very simple questions. We move on. Yes. So you can reach us on 0735 346 777 for lessons and also revision. Lessons we are beginning next month, that is May, 5th of May 2024. Lessons will begin for financial reporting from the first topic to the last topic, financial management from first topic to the last topic, and taxation also from first topic to the last topic, and finally financial accounting from first topic to the last topic. So we are just finalizing this week the revision. So tomorrow I'll be handling financial reporting, and then I will wind up by next week Friday. I will wind up this particular revision, and I will be able to hand over to you to CASNEP to go there and handle your paper. So ensure that you have this information right. Bye.